Hello everyone, I hope you're having a wonderful day, and if you work in logistics and supply chain, I want to take 10 minutes of your time. My name is Ananya and I'm a market research analyst at Container xChange, a technology company that offers shipping containers for trading and leasing along with efficient payment infrastructure and digital solutions. And every month we study the market trends, strategies, the participants, and create research reports around them and share their insights. Today, I want to share the key findings of one such report with you. What's happening in the world? Prices of groceries and products are increasing? Well, yes. The US Consumer Price Index report concluded in February that inflation figures rose higher than expected in January, while the UK inflation figures came in slightly lower than expected. Mid to or short to midterm uncertainty about inflation, GDP, and prices remain high. And because of this, containerized volume and rates are also, the future of those volumes and rates are shrouded in dark clouds. The big east-west trades have been hit the hardest. For example, the Trans-Pacific trades are recording more than a 30% decline year on year. Whereas the regional trades such as Asia or intra-Asia and so on have had relatively stable traffic and rate. Carriers have already been blanking sailings, but now they're suspending entire services on some routes. However, that would still not be enough, and that is why rates are still low. The result? All major shipping lines have already reported a decline in their Q4 2022 reports. This is a negative outlook not just for 2023, but we also expect a rate war on the horizon. When demand had dropped in 2020 because of COVID-19, carriers had cut liner capacity to match the drop. However, when demand lowered again in 2022, this time the carriers did not choose to do the same as a swift response. As a result, the contract rates and spot rates the difference between the contract and the spot rates is now marginal. And with the carriers choosing to not cut capacity, this almost looks like a price war has just begun. So where does this leave the industry? Well, if the price competition continues, margins will be tighter for freight forwarders. The focus will be on minimizing risk, enabling digital robust infrastructure, making predictive analysis based on data visibility. And so the industry transparency will also be crucial in these circumstances. When we analyze data through our product insights, we notice that this might be a good time to lease containers out of China, as we not only see a high availability of boxes in the ports there, but also because we expect a gradual recovery of container demand in China soon. The country is moving out of restrictions from COVID-19 and the recently celebrated Chinese New Year. It was always expected that there will be more inbound containers in China at the beginning of the year. More so because a lot of these units are being repositioned and imported back to China from the US and Europe after their peak seasons ended at the same time. So naturally, the Container Availability Index, also known as CAX, showed higher congestion at ports in China in January when compared to the last 3 years. The rates have remained low. For example, in Shanghai and Ningbo, the average prices of a cargo-worthy 40-feet container were $1,670 and $1,630 respectively. Just a year earlier, which is in February 22, the average prices for these boxes were around $4,500. There is now a sufficient amount of containers available and more TEUs are expected in 2023. With the competitive dynamics right now, big players will not be expected to hold back. And because of this, we expect the prices to come down at variable costs. Besides, the 2M alliance of Maersk and MSC, they have just announced that they will split and go separate ways after their contract expires in 2025, which means that other alliances may also reconsider their contracts, and this is going to affect shipping rates as well. When we speak of China, the country's key competitor, India, cannot be left far behind. When it comes to energy, investment, and other such resources, the Middle East is turning out to be a critical source for India. And India is leaving no stone unturned to uphold healthy bilateral trades with certain countries in the Middle East. For example, Egypt's president was India's guest of honor at the latter's Republic Day festival this year. India's External Affairs Ministry had said that more than 50 Indian companies had invested more than $3.15 billion in chemicals, energy, garments, agribusiness, textiles, and other parts of the Egyptian economy. And already, the UAE and Saudi Arabia are India's third and fourth largest trading partners, respectively. On our leasing platform, we saw a growing demand to ship cargo from Indian ports to the ports in the Middle East, and the pickup rates had increased too. For example, the average pickup charge to ship a box from Mundra to Jebel Ali rose from $50 in December 2022 to $75 in January 2023. As far as the prices of the boxes were concerned, in India, the average price of the box in February 2022 was around $4,600, whereas by February 2023, which was only last month, the average price dropped to $1,800. Well, what does it mean? It means that as far as the containerized market is concerned, India right now is a steadier market than China is. But of course, it's because China is still coming out of the Chinese New Year. Another advantage that India has right now is that ocean carriers are redeploying tonnage to some of the Indian ports. For example, MSC's Sentosa, which is its Asia-US West Coast connection, it will now include Nhava Sheva and Mundra in India. And this is one of the many examples. Now, what's happening in the US? On 21st February 2023, some of the world's largest retailers announced their holiday season sales and painted a bleak picture for the rest of the year. The world's biggest retailer, Walmart, forecast full-year earnings below estimates. The brand share fell by 2.6% to $142.5 in pre-market trading. At the same time, shares of Target were down by 2.10% and Costco by 1.25% in pre-market trading as well. With inflation, rising prices of groceries, products, and unpredictable consumer behavior in a shaky market, the retailers might have a slower growth in 2023 than what the Wall Street might expect. Retailers will need to lower prices to make profit, even if marginal, because consumer demand is weakening, and this will eventually affect their profit margins. And container shipping is going to play a major role in determining their fate. On our platform, the average price of a cargo-worthy 40-feet container has been more or less steady this year compared to the last quarter of 2022. While in January, the price was around roughly $2,500 on an average in the first week, it dropped by almost 6% to around $2,300 after 6 weeks. On our leasing platform, we saw that the average pickup charge to ship a container from the US to China was around $500. After a year of roller coaster rides, the price seems to be finally stabilizing. For importers in the US, there's already a lot of pressure on them because of costs that are attached to labor, raw materials, and energy. So it is going to ease their operations if ocean shipping rates are lowered as well. That was a quick lowdown for this month. Thank you so much for staying with me. We will return with more forecasts, more price trends, and more information next month. Until then, please follow our LinkedIn page. And if you want the link to download our research reports, please do not hesitate to reach out to us. Thank you and goodbye.